Welcome to another episode. My name is Jose Najarro, and today we're going to take a look at quarter four for Square. They just reported earnings today, February 26th, so let's see what's going on with the company. Alright, so first let's take a look at how the company is doing after hours. Square is up about 7%, 6.87% to be exact. It's up to $81.85. So in today's episode, what we're going to do is first we're going to take a look at the shareholder letter that they provided, and then we're going to dig into some of the financial documents that they've also provided. Don't forget to subscribe, guys. I post content like this almost on a daily basis during the weekdays, so I hope you guys enjoy. Make sure to post in the comments what company you want me to take a look at next. Alright, so next let's take a look at how this company did in earnings. Here I'm on seekingalpha.com. Quarter four non-GAAP earnings per share were 23 cents and it beat by 2 cents. GAAP earnings per share were 83 cents and it beat by 82 cents. So you guys might be wondering, hey Jose, how come non-GAAP earnings per share and GAAP earnings per share are different right here? So non-GAAP earnings per share are usually earnings per share that do not include one-time events. So the reason we usually see non-GAAP earnings per share is because companies prefer doing non-GAAP earnings per share because they say some of these events only occur once. Where GAAP earnings per share is things that are mandatory by the SEC and you have to report everything, right? It gives you the true picture of what the company is doing. One thing we're going to see in today's episode is that Square did sell a business. Honestly, we'll take a look. I can't remember the name of the business right now that they sold, but that's why their GAAP earnings per share, which is everything they have to report, is higher than their non-GAAP earnings per share because they had a one-time profit of selling that company, and that's why they had that 83 cents on GAAP earnings per share. Revenue for the quarter was $1.31 billion. And like I said, right, this is for the fourth quarter of 2019, and they already uploaded their 10K report, which is pretty good for me because then I can use this great website. And the revenue for this company for this year was $4.71 billion. And look, you can definitely see this company is continuing to grow revenue at a strong pace. Just in 2018, this company was 3.3. I took a look. So from 2018 to 2019, this company grew 43% just now. And then they gave us estimates of what they're expected for 2020, which we're going to take a look in a bit. It's about $5.96 billion. And compare that to the current revenue today, will give this company a 27% growth next year. So we can still see heavy growth on this company in form of revenue. I just want to take a look at past revenue growth to see how this company has been growing. So excuse this real quick. So revenue growth here for this year grew about 43%. Last year grew about 48%. The previous year, 29%, 2017, and 2016, 34%. So we can see this company gives us somewhere between mid-20s to high 40s type of revenue growth in the past 4 years. So we can see with the expected one for 2020, it's about 27%. So it falls in line with, and that's pretty impressive. That to me, I like to see companies that grow their revenue that strongly. So let's take a look at another article that I had here first. So they gave us guidance for 2020. They have adjusted earnings per share of about 90 to 94 cents. And the overall analysis say that it's around 95 cents. So it's a little bit soft compared to what analysis expected for the upcoming year. But right, companies like this usually give you a little bit lower guidance just because then later on, this is what I see most of the time happening. Later on during the year, they're like, yes, we beat our guidance. We're such a great company. And it's just, right, they give themselves a little leeway of how much they can beat. And like I mentioned, they see total revenue of $5.9 to $5.96 billion. Again, this usually revenue, they usually give a little bit less, a figure that they know they're going to reach. And sometimes, most of the time, we're going to see a guidance beat on what they give us. So before we begin with the thing, I just want to do a quick evaluation based on this company. So then I took a look at TD Ameritrade, and they have this earnings. Usually I get it from Seeking Alpha, but Seeking Alpha hasn't updated for 2 years from now. So for 2020, this analysts expect this company to make somewhere around 96 cents. Remember here in the article that we were just taking a look at, they say that they're going to make somewhere between 90 to 94 cents, and the analyst consensus is somewhere around 95 cents. So we can see this 96 cents is right on line with where they're talking about. For 2021, which is 2 years from now, and I like to look at forward PE ratio based on 2 years from now, and from 2 years from now, they expect it to make $1.32. So $1.32 forward PE ratio at the current price of $80, right? This company is right now at $80. 80 divided by the 1.32 gives this company a forward PE ratio of 60.60. And to me, just looking at this right now, just based on the valuation right here, it's not something I would enter. Me personally, right? Each investor has their own thing. Some investors, I see this company has a strong growth. One, I do see this company has a very strong growth in revenue, and I might change my mind by the end of this video, right? Because we still have to take a look at this company's balance sheet. We still have to take a look at how much this company owes and other aspects of what the company's doing that might change my mind. But for me, it has to be something very, very crazy for me to really be like, hey, a 60 forward PE ratio on 2 years is looking good to me. Like I said, this for me at the moment would not be considered a good investment. But that does not mean it is not a good investment, right? Each investor has their own type of risk to reward, thick skin. So for someone else that's truly in a true growth only type era, maybe the 64 PE ratio is not a big deal, especially because it is growing by strong double digits in revenue every year. All right, so we took a look at that. Let's go and jump into the shareholders letter. So here in the shareholders letter, I went on and it's about 30 pages, I think. I highlighted the most important things, the things that I found interesting. So I highlighted highlights. So first, we're going to talk about that they continue to drive growth at scale. And like they mentioned, right, total net revenue and gross profit grew 41% and 39% year over year. They have their seller ecosystem continue to drive growth in the fourth quarter of 2019, with total net revenue and gross profit growing 26 and 27%. So one thing we're going to take a look at is later on in this slide. So we're going to talk about the different types of revenue and the different types of product the Square has. Another one is their Cash App. Cash App growth remains strong with total net revenue growth. Profit increased 147%. And revenue increased 140% and gross profit increased 104%. And you know, one thing that I'm taking a look at here is revenue is growing and gross profit is growing in similar percentage wise. So, and that to me is a good thing. Usually, sometimes you see revenue growing by some dramatic number, but gross profit is not growing by that same type of number wise. And here we do see that, right? For their overall system, 41% growth in revenue and 39% growth on gross profit. And here in Cash App, right, where they grew revenue by 140%, their gross profit grew by 104%. So we can see, right, that as revenue is increasing, their gross profit is increasing in a very similar type of percentage-wise. Cash App had approximately 24 million monthly active customers in December of 2019, which was achieving a 60% year-over-year growth on membership. So we're going to see, right, in their overall business, they're growing in heavy double digits. In their seller ecosystem, they're growing in the 20%, in the high 20s, which is really good. And in their Cash App, they're growing by 100% profit and 100% revenue. And they're also increasing their customer base by 60% year over year. So we can see this company is definitely a huge grower. So now let's take a look at net income. We already talked plenty about total net revenue. This is for the fourth quarter. Net income for the fourth quarter was $391 million. And if we take a look at previous quarters is usually in the low 50 millions. Most quarter 2, quarter 1, and quarter 4 of 2018 were all a net income loss. So this company has been burning money for the past 3 quarters. Quarter three was the first quarter it seemed to have actually provided a positive positive net income. And right here we have a 391 for quarter four. But like I mentioned, remember this company sold a company, a part of its company, Caviar, and it sold it for 373 million, and that's how much it gained out of that sale. So in reality, this quarter four net income is somewhere around 19 million, which again, it is still better than their 28 million loss that they did in last quarter four. Some other things they mentioned that I thought was pretty cool is this is the what they call GPV, which is gross payment volume. So here, right, one thing we're going to talk about their products later, but one thing Square does is they go to businesses, all types of business sizes go and use Square to be able to process payment for them. So now with Square, they're able to take different types of payments, different types of credit cards, Apple Pay, Google Pay, all the non-chips, chips. So it allows, this is a company that helps other companies collect some form of revenue. And here they broke it down by the type of businesses they're providing. So 45% of their revenue comes from businesses that make less than $125,000 in sales. And $125,000 for sales for a company is definitely what one would consider a small business. 55% comes from larger sellers. So 27% comes from a company that sells somewhere between $125,000 to $500,000. And another 27% comes from companies that make over $500,000 of payment volume per year. And that's just something good to know, right? It's not just small businesses that use Square. It is some big companies that are over in the 500,000 plus revenue base. And that's good to note, right? Because if in future things, if things start to go bad, it's not all, if small businesses close, yes, it will affect Square, but this company has over half of it based on bigger companies that will be able to withstand some form of negative impact in the economy. All right, let's keep scrolling. Let's see what we did. Here, like I mentioned, on October 31st, 2019, they completed the sale of Caviar and they sold it to DoorDash, which resulted in a gain of $373 million in the fourth quarter of 2019. So here we're going to see this company has different products. One of the first products we're going to talk about is their seller ecosystem. So here in their seller ecosystem, they have a whole form of almost off the shelf for restaurants. So if you have a restaurant, if you have some form of business, they provide you with the type of products and hardware you need to be able, and the services. So all these come in different aspects. They sell the hardware for it, they sell the software for it, and then they sell a subscription for it. So if you have a restaurant, right, what they do is they have a software that you can set up and create your own type of restaurant with tables in there, and then be able to add the food you sell in that restaurant. So then when you have a table and you know what they order, you can already click on the table, put the items that have been ordered, and it creates the bill and stuff for them. So this is pretty much a whole ecosystem for the seller. So that's one of the first thing. The second thing that they do is they have what they call Square Capital. So Square Capital is pretty much a loaning. They have some form of loaning for small businesses, well, for all types of businesses, not only small businesses. So they provide form of loans on the company, and then the company pays back on interest. In this, for the fourth quarter, they approximately about 97,000 loans, totaling $671 million worth of loan, which is a 42% growth from compared to same time last year. So even their capital, their loaning business is increasing. And at the end of the day, right, their loans, I think this is a pretty smart for them, because their loans help their sellers invest, and in return they grow, the customers invest, they grow their business. So if they grow their business, they produce more revenue. If they produce more revenue, they get charged per transaction for Square. So Square even makes even more money from there, and they make more money from interest based on giving this loan. And this loan usually has a pretty bad loss rate of below 4% on average since 2017, and that's definitely a very low number to have on loan. So it means that this company is making money off this. So next we're going to take a look at this company's global impact. Mainly right now, the main market for this company is the United States, but they're trying to go globally. Right now, they just released Square Restaurant in the United Kingdom and in Australia. And Square Restaurant was that previous product that I mentioned, right? That they get the cashier, they get the software, they get some subscription service, and they end up paying for transactions. And here with Square Restaurant, with their software, they're able to create the restaurant layout with the tables, so they're able to track what they're selling. And at the end of the day, it's a pretty much a one and all solution for restaurants. They're also going to start doing Square terminals, are also launching in both UK and Australia in the third quarter. These Square terminals are what you see here right now. You can see them right here. It's pretty much just a terminal that stores use to be able to take different types of payments. And right, this Square terminal is not only going to be for the restaurant market, it's going to be for any type of business there in the United Kingdom and Australia. They did have some pricing change here in the United States. They did increase. Swipe transactions now cost 2.6% of the transaction plus 10 cents. And they're saying that there hasn't been much impact right now due to this increase in transaction price, but they're going to continue to monitor this activity because it might take a few quarters before they actually see an impact on this. But they do provide some form of quote from one investor, from a small business, that say, hey, even with the rate increase, Square is still the best value of all the services around. So they're just trying to show their investors that, hey, even though we increase our price, we're very confident that we're not going to lose customers. So we're going to still contain a high customer base and collect more money from them. Next, we're going to take a look about their Cash App system. So their Cash App ecosystem has two forms of thing. The main thing, the first and the most important one is, and the biggest one is their their money transferring. So you know how there's all these types of PayPals and what's the other one, Venmo, where you transfer peer-to-peer transfer of money. This is one of them. This is one of these Cash Apps, and this is the one that grew 60% active customers year over year. So in December of 2018 they had 15 million, and now December of 2019 they have over 24 million users. The next one is they have this investing app. They just launched an investing application with fractional equity investing. So you can buy companies with fractional. You can buy companies with as low as $1, no matter the price. You're just buying a fraction of that company. And within the first 3 months since launch, it has seen the fastest adoption of any product ever launched by Cash Apps. And the average customer right now, I just think this is pretty. It depends on the type of investor. The average investor is buying around $20 of stock every time they make a purchase. Small investors right now entering into this Cash App system. But again, just by doing this, by having all this type of different products, and they all have to deal with money. So at the end of the day, they all tie together. If someone's using the Cash App for investing, then they're probably going to end up switching to using the Cash App for peer-to-peer transfer. And then when you do Cash App to peer-to-peer transfer, you're going to start telling your friends, hey, use Cash App so I'm able to send you money. And then they continue to build their customer base and their brand awareness. So eventually that revenue and that customer awareness continues to grow in a similar pace. Then they talk about, I think this is pretty cool, revenue growth based on their Cash App application. They do mention that Cash App's number of monthly active users has grown rapidly, but they said that the revenue per users has grown at a faster pace. For example, in December 2017, right? In December 2017, per user, this company was on Cash App was making less than $15 per user. Now, per user, they're making over $30 per user. So you can see that revenue per user is growing. So let's keep scrolling and see what else we see here in Cash App. I think now we're actually moving on to just the financial base of this company. This company was kind enough to put everything in one slideshow. So first, there's other two types of revenue we can talk about. The other two types of revenue we're going to talk about is subscription based and hardware based. So their subscription based is like I mentioned, right? They sell some form of subscription based on their software for the companies to use. And then the hardware are those hardwares that we saw. They sell different types of hardware. If you guys here in the United States have seen, for example, some companies have the Square application where they connect it to their phone and they can swipe a card to their phone. You might see it in some of the food vending trucks. Then the typical iPad thing as well. So they have different types of hardware that they sell to small businesses. So right now we're going to be talking about revenue excluding Caviar, right? Because we don't really care about that company. So excluding Caviar, subscription service revenue was $266 million in the fourth quarter of 2019, and it's up 78% year to year. And gross profit is up 73% year over year. So like I keep talking, right? This is something very good to mention, that while revenue is increasing, gross profit is increasing at a similar pace with it. And I think that's a very, very cool thing to see. Next, we're going to be talking about subscription for the full year of 2019. Subscription revenue for the full year of 2019, excluding Caviar, was $886 million, which was up over 100% year to year. And gross profit was up 96% year over year. Next, we're going to take a look at hardware revenue. Hardware revenue for the fourth quarter was $22 million. Very low compared to everything else. But I mean, at the end of the day, I think they're pretty much more on the software and the transaction costs. But it's good that they still sell the hardware because they're able to make money out of it. Actually, no, they don't. 22 million, like I said, for the fourth quarter. And it's up 23% year over year. And it generated a gross loss of 18 million. So they're actually losing money on the hardware, but that's because they just lowered the pricing on two of their newer hardware devices, the Square Register and the Square Terminal, which affected their gross margins for the fourth quarter of 2019. But they're saying, hey, if we're able to get people to buy our hardware, they're gonna pay for the subscription. And that's where the money and the transaction costs, and that's where the money comes in. So it's okay for us to take a loss in the hardware because in the long run, we're going to be making money from this customer elsewhere. And this is what we see in the gaming industry. In the gaming industry, most of the game systems actually lose money. Where the company makes money is where the subscription, the yearly subscriptions, the video games themselves, and the accessories. So sometimes you have to lose money somewhere where you can pull them in and lock them in there and make money somewhere else. All right, next we're going to talk about operating expenses. Operating expenses were $510 million for the fourth quarter, and it was up 33%. For the full year, it was $1.86 billion, and it was up 39%. So it's up in that 33%. We're going to see where this cost is coming. The first is going to be product development expenses, where up 22% compared to the same time last year. And this increase was mainly driven because they have more personnel costs related to engineering, data science, and design teams. So that's pretty good. I, as an engineer, like to see, hey, engineers being hired. And by engineers being hired, it means they're developing better process, a better system for a better hardware, better software. And with the data science, they're getting better information based on the data that they're collecting, and the design team is making sure that the UI interface is looking good. So then in the sales marketing was $185 million, and it was up 55%. This up 55% was mainly due to the Cash App marketing expense, which was up 99%. So we did see a lot more ads this year based on Cash App. They're trying to really market this business, market their cash applications. General and administrative expenses were $118 million, up 24%. And this was due to primarily addition increase in customer support, finance, and legal personnel. When you increase your revenue, right? When you're increasing revenue, it means you're collecting more customers. If you're having more customers, maybe the percentage of problems you have still remain the same, but because you increase the amount of customers, you have more customers complaining. So you have to increase your customer support. And again, as with the same, you go with your legal personnel and your finance people. Transaction and loan losses were $32 million. So this is either what they lost from maybe something in the transaction went wrong, or one of their loans didn't get paid. So they have a $32 million loss in that, which is actually pretty small, right? $32 million is it's almost nothing to what did they make? $4.3 billion that I said for the year. or in 1 point something billion dollars for the fourth quarter. So 32 million is a very small amount, and sometimes, and right, you have to, some companies take losses, and that's okay. And it's up 31% year over year, but 31% of 32 million dollars is very small. So again, this to me is not a big deal. Seller transaction losses remain below 0.1% of GPV, and like we talked about their Ford Capital, which was the loan, they see a loss of less than 4% on their flex loan products, which again it's something I'm not too worried about. This is a lot of paper. I definitely took me some time to read this today, so I hope you guys are enjoying this episode. All right, so we're almost done actually. All right, so now we're going to take a look at this company's income statement. Most of their revenue we have talked about. We've actually talked about it in the previous in the previous slides. But here we just highlighted. I just highlighted to show that hey, we see the strong growth in all types of segments for this company in both quarter to quarter and year to year. So it's pretty impressive. Especially the one that I like to see the most too is subscription, both transaction and subscription growth, and those are the ones growing the most, right? Because transaction-based revenues, even though this means businesses are doing good, they're selling more products, so this company is making more money from other companies making money. So it's a win-win situation for everything. And subscription services continue to grow, and in the long run, right, this is money that's just going to keep coming in, and keep coming in. We also talked about the cost of this company's expense, and transaction-based cost did take a big jump. They also had Bitcoin cost, and in their 10K report, they talk about their Bitcoin revenue and their Bitcoin cost. It's not something I really want to talk about here today, so we'll probably skip over that part. But total cost of revenue grew about $900 million year to year. A big portion coming from that Bitcoin cost and that transaction-based cost. Next in the income statement, we talked about all the operating expenses, right? We talked about product development, we talked about sales, we see growth in there, and these are two that I definitely like to see growth, because in product development, it means this company is focusing on bettering its business, and in sales and marketing, it means this company is trying to get more customers. So that's, even though it is an expense, I like to see. You need to power down and go get more customers. You can't just do that freely. You have to spend money to make money. Next, I want to take a look at interest expense, and this interest expense rate tells me how much this company has increased in debt, or if its company is very heavily debted, because it tells me how much they're paying, right? There hasn't been much growth. Last year they paid about $18 million in interest. This year they paid $21 million. Not a huge growth, but there is a growth, so it means that this company is increasing its debt somewhere in its finance, where it's paying interest. And this provision for income taxes, just like me and you, companies need to pay taxes, right? And taxes, how much they pay in taxes is how much this company truly made, right? Depends on how much this company truly made. So last year they paid $2.3 million in taxes. This year they're paying $2.7 million in taxes. So they're paying more in taxes. So what does that mean? That means this company made more money this year compared to last year. And that's all we really care about. So this company is telling us the truth when it's saying that, hey, we're making money. Now let's take a look at this company's balance sheet. And this is my favorite type of documents of all to take a look at. First, we're going to take a look at total current assets. Total current assets grew about $1 billion, and $500 million growth comes from cash and cash equivalents. Pretty good. They have $100 million less in investments in short-term debt, but that's okay, right? We see that huge growth in cash and cash equivalents, so it's not bad to see investments in short-term debt going down a bit. I honestly, if it was me, right, if I had $1 billion to use, I would definitely be investing that money and making that money grow. But this company wants to hold it as cash for right now. Settlements, receivables has increased compared to the same time last year, and so has customer funds increased compared to the same time last year. And this is to be expected, right? They have more customers, they have more transaction costs, they have more revenue. So these are the types of current assets that you would definitely see grow the most when we see that growth in revenue. Next, we're going to take a look at long-term assets. The only one I really care about here, and the only one that really has fluctuated a lot, is investments in long-term debt securities. They increased long-term debt securities by about $60-70 million compared to the same time last year. So this company at least wants to invest more in in some sort of long-term asset. Total assets at the end of the year grew about $1.3 billion, and a huge portion of that is coming from total current assets, and a huge portion of that is coming from cash and cash equivalents, which is a great thing. Next, we're going to take a look at this company's liability. Right, in customers payable, when you increase revenue, it means you're selling more products. If you're selling more product, it means you probably have to get more products, or get more products made, or more services made. And that's why customers payable does not, we're seeing a huge increase in this, about $500 million in that, but we increased our revenue dramatically. So that to me is understandable. Total current liabilities grew about $700 million. A huge portion of that comes from customers payable. Nothing to really be totally concerned about. One thing I do like is total current assets and total current liabilities. Their ratio is 2-to-1. Pretty much this company has twice the total current assets compared to total current liabilities. That is, it's not a true ratio to really focus anything on, but it just tells you, it's just a quick look that say, hey, this company has a lot of cash and is able to not worry about its long-term at its current liabilities. Long-term debt has increased a little bit. It grew about $40 million, and that's why we see about that $3 million increase in interest that we saw in the income statement, right? So these things tie together, guys, right? We see an increase in long-term debt. So if we see an increase in long-term debt, it means that this company is going to pay more on interest, right? Because if you have, right, just for you, if you have more credit card debt, obviously you're going to pay more on your interest. So we do see an increase in long-term debt by about $40 million. But look, at the end of the day, this company, if it wants, I'm not saying it's the smartest thing to do, I'm not saying it should do this, but if ever needed, this company can actually just take off all this cash and just pay off its long-term debt and say, hey, screw you long-term debt, I don't need you. But right now, with low interest rates, right, we're sitting at one of the lowest interest rates right now out in the market. I don't think this company needs to go and pay off any form of debt. Total liabilities were $2.8 billion. It grew about $700 million. So total liabilities grew $700 million, but total assets grew by $1.3 billion. So total assets, even though they're both growing, total assets is growing at a stronger rate. The final thing we're going to take a look at is this company's cash flow statement. Net cash flow provided by operating activities was positive, almost $500 million, which to me, I always like to see a positive net cash flow from operating activities. One thing though I do see here is this company does pay share-based compensation, which is pretty normal, right? It's something that is normal in the market right now, and that only grew by $80 million. But remember, they did mention that they increased personnel in engineering, in sales, and everything. So obviously, they might not pay them at a competitive rate, but they give them share-based compensation to make sure they have skin in the game. So I think that's it for all the information we have here. So now my thoughts on this company. First, right, this company has a very strong revenue growth, right? We see this company growing at a strong double digits. We see all of its products growing at a strong double digits. Not only do we see revenue growing, we also see gross profit growing at similar rates. That to me is very good. Unfortunately to me, the valuation right now on the forward PE ratio for 2 years from now is still pretty high. A 60 forward PE ratio, to my, it's pretty high. But who knows? Maybe for 3 years it would be somewhere in the 40s. But to me, that's such a long time for all this, for an investment for me to eventually to make sense, right? I want to buy an investment right now that has growth, right? The best type of investment. I want an investment that has strong growth and that right now is valued pretty cheaply. Right now, this company has strong growth, but its valuation at the moment might not be cheap compared to my standards. It might be cheap to other standards, and that's okay. We saw this company has different types of products and all their products tied together, which I think is pretty cool. We see this company spending more on research and development, and we also see more in sales and marketing, which is helping this company maintain its growth, continue to get more customers, and continue to be on top of their game with products and software and subscription. We see this company diversified in different types of things. We see the Cash App, we see the capital loans, and they all make sense, like I mentioned, right? And next, the balance sheet, right? The balance sheet is really good. I definitely like how this company has plenty of cash at hand, and it has more cash than long-term debt, which I think is very important. So let me know what you guys think about Square. Make sure to post on the comments. Take care, guys. Have a good night, and see you next time.